Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 22.98% year to date. Here, the number one goal at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor. Not an easy task to do, I should say. Most investment advisors cannot beat the returns on a consistent basis of the S&P 500 buy and hold investor. Their portfolio is currently up 20.23%, and our model portfolio is beating that by about 3 percentage points, just under. We do have a green for the stock market strength color signal. This is going to be a full monthly video, so it's going to be longer than the normal intra-month videos. We are going to do a deep dive into the S&P 500 and the stock market. Here are some past returns for the model portfolio. Last week, the S&P 500, by the way, we use the ETF SPY. We refer to it as spiders, and we use that for just about all of our charts when we are talking about the S&P 500. Last week, the S&P 500 gained 0.57% for the week. This is a 5-year weekly chart for the S&P 500. And here we are trading right there, which is just below this valid trend line taken from that cycle low and that cycle low right there. We are trading on the back side of that. Now, we do have a negative divergence that is beginning to correct itself because we just went positive on the MACD. So pretty much that negative divergence, which has been looming over us on the MACD, is correcting. These are bullish signs when we're talking about taking that negative divergence, and it's not having as much of an effect or meaning thus far. Last week, we made no trades. Now, here are all the trades that we've made in calendar year 2024. And we currently have 2 open positions. We currently have 200 shares of SPY. We are very profitable in that by 17.16% or $16,744. We started the year off with 100,000, and we build out the year with our investments and try to grow this portfolio to as much as possible throughout the calendar year. So that's our goal here. And this is how we do it. Now, we also have an in-the-money covered call, which I did purchase, or actually I sold a covered call on 9/13/24. Now, that has an expiration date of Monday. So we are going to let that in-the-money covered call expire. Our shares are going to be taken away from us, the 200 shares, at the strike price of $520, which is perfectly fine. We got paid for that when we sold the in-the-money covered call. So we're not really losing anything here. So the portfolio as of Monday is, at the end of the trading day on Monday, will be in cash for us to decide how do we want to spend our just under $123,000. If you want to see how I consistently trade this portfolio, go ahead and smash that like button down, subscribe to my channel, and ring that bell. All right, now here is the model portfolio equity curve for 2024 year to date. You can see we have a nice slow steady equity curve. This is the equity curve for the S&P 500 buy and hold investor for the same time period year to date 2024. Here are the 2 equity curves combined because we want to compare our model portfolio against the benchmark of the S&P 500 buy and hold investor. We are currently surpassing their portfolio, but not by much, by just under 3%. Now, I've been going flat for the last few weeks because of that in-the-money covered call. They have been advancing because the stock market has advanced for the last couple of weeks. In September, which generally speaking is a poorly correlated month for profits or increases in the S&P 500, I was expecting us to have a softening, and we did not. So I'm thinking that softening is still going to come, but since it did not come in September, it will come in October. So that's where my head is at for right now. All right, during the last month, we have had some movement by the Fed Chair Jerome Powell. They did a 50 basis point cut on the announcement came on September 18th. The next announcement will be November 7th, which is after the election of November 5th. Are they going to do a rate hold, cut, or hike? Now, I've got the word cut highlighted here because that's what the Fed has told us they're going to do. After the Fed made the announcement, this post came out by Jennifer Schausenberger here, and what she says is the Federal Reserve slashed interest rates by the 0.5 percentage point Wednesday and charted a course for 2 additional cuts this year. Well, there's only 2 more meetings this year. And so that means probably quarter point, if the Fed is actually going to follow through with that, followed by 4 more in 2025. Now, there's a few interesting things about what I'm saying here. Number one, the Fed did nothing all year long. And then a meeting just before the election, the Fed decides to cut 50 basis points, not even 25 basis points. That's surprising because normally speaking, on an election year, the Fed would not do anything for at least 2 Fed announcements prior to an election because they don't usually want to be somehow involved in election tampering, which it seems like they actually did on this go around because they did a 50 basis point rate cut, one at the announcement just before the election. So that was a little shocking. And the Fed, the stock market, generally speaking, likes the cuts because the cuts help stimulate the economy. Now, the only disturbing thing here is that the Fed has already stated that they've already done 50 basis points. Now they're going to do 2 more quarter points. That's a full percentage point for 2024. Then they're going to do 4 more rate cuts in 2025. That seems like the Fed is spooked. I think it's the unemployment rate that is spooking the Fed. But with this type of language, it seems like the Fed is nervous that the unemployment rate is going to be ticking up and the economy is going to be ticking down. Otherwise, why else would they be talking like this? All right, now we are looking at a chart of TNX. That is the candlestick chart with the candlesticks red and black. There's also the S&P 500 in dark blue, which is right there. And we also have TLT 20-year bonds, which is in black. Now, I have been expecting that we were going to get a tick up in the 10-year U.S. Treasury yields, which we've started to do that. We've started to tick up. Now we're kind of moving sideways here. I see us in a trading range from here to here. And that's why I've got this green line drawn, because I'm expecting that we're going to tick up to eventually meet this trading range right here, where we had a top before, wherein it showed that it bounced off of it. So that's kind of where I am thinking. Now, normally speaking, as you tick up, the S&P 500 would tick down. It did not. TLT did tick down, but the S&P 500 did not tick down. It held its ground. So I'm thinking that it is due for a little bit of a tick down due to this tick up in the yields. All right, now we are looking at things from the presidential election cycle theory. And it states that depending upon the year of the election, what year you're in compared to the election, I should say, will determine what your historical rates of returns are for the S&P 500 and over here for the NASDAQ 100. Currently, President Joe Biden is in the 4th year of his term. And historically, that averages 6.7% for the S&P 500. Where does the S&P 500 currently stand? It has a year-to-date return so far of 20.23%, giving you a huge drop of approximately 13 to 14% just to meet the historical average return for the president's fourth-year term of 6.7%. A lot of risk in this market at that elevated level is what I'm trying to give you guys the information of. Now we are looking at things from the bond market. We've had an inverted yield curve about 2 years. That yield curve is finally beginning to correct. This is the 2-year yields. This is the 10-year yield. Now, normally speaking, the 10-year yield should have a higher yield than the shorter term 2-year and 91-day yield. Now, we have accomplished this on the 2-year yield, but not the 91-day yield as of yet. So what is the bond market saying? It's saying that there's more risk going out 10 years than there is going out 3 months. So it's giving you these yields that have higher 3-month returns. So this is still inverted from at least the 91-day yield to the 10-year yield and also the 2-year yield. So we still have a little bit more to go before we're totally normalized. But this is the first step towards a normalized yield curve. So we are beginning to normalize. So I put that down here in green. Normally speaking, 1 to 4 months after you've got a normal yield curve, after you've been in an inverted yield curve for some time, that is when you're going to experience a economic and stock market correction. So there is risk in the next 1 to 4 months, and use that with a grain of salt. It could be 1 to 6 months, 1 to 8 months. The market's going to do whatever it wants to do, but risk is going to be present in 2025. All right, now we are looking at the CNN Business Fear and Greed Index. There is our friend Warren Buffett, the Oracle of Omaha. And where are we at? We are in greed and at 68 compared to 1 week ago at 63. So the needle is moving towards extreme greed. This is how to use the Fear and Greed Index. All right, now we are looking at things from a seasonality outlook. And depending upon the month of the year that you're at, it will determine what the probabilities are of if you're going to close the month higher than when you opened the month. Now, for the month of September, this was reading a 0 for the last 5 years, but we just got, for the first month in September, and this is going to be the 6th year, a green candle. So that changed this ratio over here to 20%. Still a deplorable month, the month of September. But look at the beautiful green candle that September is developing. There's only one more trading day left. So let's just assume that this is what the closing month is going to look like, assuming that nothing drastic is going to happen on Monday's trading, the last day of the month, trading month for September. So assuming that this is your closing candle, that is a nice looking candle, just like the month before. But generally speaking, September has been an extremely poor month. So we did not get that red candle in September. I'm going to now suspect that we are going to get that red candle in October. That's where my head is at on those regards. Now, down here, we've got the average annual S&P 500 return going back 5, 10, 20, and 30 years. You somewhat average between 10 and 7.5%. Where do you currently stand? You stand at 20% for the buy and hold investor. We are double the very good years, which is the 10 years from 2013 to 2022 of 10.41%. We're doubled that. So you want to be very cautious on how much risk you want to take moving forward in the rest of the year, because historically speaking, the years average these types of returns. So you just want to be cognizant, and you want to protect the profits that you already made. All right, now here is what the older, prior to the month of September, this is what the 5-year look back was. And you can see that in September, we had absolutely not one positive month going back 5 years. This is going to be the first year out of the last 6 years that we've actually had a positive month. Now, going back 10 years, I did draw this one today, so this information is very fresh. Month of September, 50%. Month of October, 56%. Probability that you're going to close higher than when you opened. But in November, you jump way up to 89%. It's going back 10 years of data. And then in December, 67%. So I'm thinking I'm going to be going long in November and just kind of be out of the market and skittish and see if we get that pullback in October before I start going long. All right, now we are looking at a 20-year chart. This is a monthly chart for the spiders. And on this chart, you're looking at a few different things. So the actual chart is the one with this dark line that's red and black. These other lines here represent exponential moving averages, just to kind of give you an idea of what's happening here. That's these lines here. They're just moving averages. Now, there's a few things that I want to point out. Number one, I want you to notice how the distance that the chart is from the moving averages. There's a pretty good amount of space in between here. And eventually we pull back into the moving averages. We've done it several times in the past, and actually it's normal market action to just pull back into the moving averages. Right now you can see, and like here in the thumbnail, it just looks like you're just heading straight to the sky. So from a long-term outlook, which this 20-year chart is, we're still in a bullish stance. We are still traveling north, and you can see how strong the advance is since here, about mid-2023. Excellent advance with one small correction noticeable on this chart right there. Now let's go to the next page down and let's see what we see. Now here on this chart, I've got it going back all the way to 1992, 1993, when the Spiders ETF started up. And from this long-term chart going all the way back to 1993, on the MACD, you can see that we've only reached this level above 40 twice. Okay, MACD levels above 40. The last one had a 25% correction. That's this one right here. I've got it identified by this line and this line here, and we corrected down 25.6% when the MACD was at that level right there, above 40. We are at that level right now. Since 1993, this has only happened twice, and you are looking at one of those times right now in real time in 2024, September 28th, 2024. So you tell me, what are the odds that we're going to see something like this and the stock market is going to experience at least another one of those? It seems like the odds favor, well, somehow the MACD has to unwind. So the MACD is an oscillator. It goes up, goes down, goes up, goes down. It doesn't just continually go up to the sky and stay there. It's an oscillator. It has to come up and it has to come down. And most likely, when it comes down, there's a few different ways that it can do that. The primary way is for the stock market to go down and the MACD will unwind. If you move slowly and steadily up like this, you can also unwind that way. Or if you move slowly and steadily down, you can also unwind if you just move kind of like in a line like that rather than a sharp decline like that. So there's multiple ways that you can unwind this MACD, but the most prevalent way is this way, where the stock market itself is going to come down and experience a correction. So I am going to be very leery in the next 1 to 12 months until I see something like this, a nice good fat correction in front of me, before I really want to take on longs with leverage and stuff like that. One thing that I want to bring out here and make a note of, when the stock market experienced this 25.6 correction and it started to go down, and that started to go down at this line right here, and that's when you had the peak of the MACD. But the slow stochastics is what ended up going negative below its signal line first, even before it went below 80. You can see over here how the MACD, the black line, went below the signal line way up high on top of the 80. Now, currently, the MACD and the signal line are running parallel, right, or right next to each other, right on top of each other, I should say. But the first indicator that's going to show us that something like this is afoot is when we start seeing the black slow stochastics start going underneath its signal line, like it did over here, right here. So if we start seeing that activity here, that is going to be the preliminary indication. Start taking chips off of the table. Start thinking about putting on short positions. So we are going to very closely be watching the slow stochastics on this long-term chart to help us determine exactly what we are up against. All right, now we're looking at a weekly chart, and this is going to go back 5 years of data, and the intermediate term outlook is bullish. Now, on this candlestick chart, you can see pretty clearly that we're breaking out, making all-time new highs here, and it's pretty bullish when you see that type of activity. The MACD is unwinding, and it's that negative divergence is unwinding because we're now going positive on the MACD. Slow stochastics is also going positive. Okay, now we're looking at a daily 6-month chart for the spiders. And here on this candlestick chart, things are still looking bullish, although we are starting to look like the MACD is starting to roll over. You can see in the histogram how you're starting to head that way. That is an indication of softening. But because the candlesticks are above all the moving averages, we've got several moving averages here, the 8, the 13, the 21, the 50, the 200, and the candlestick, which is the spiders, is all above that. It still has bullish structure to it. We need to start breaking down to start to see the signs that this market is falling apart. Right now, you don't see that. This here is a ratio chart for the NASDAQ 100 against the S&P 500. It's an indication of risk on, risk off. Now, the ratio chart is the chart that's in black, in red and black. And there is also a 10-period moving average in the solid red line. When you are above the 10-period moving average like you are right here, that's a sign of bullishness or risk on. Well, there's the 10-period moving average, and we are clearly above that. So we are in a risk-on situation. Also, you see a low, you see a high, you see a higher low, and you see a higher high. All these things are indications that risk is on right now. We do have a top in play right there. The MACD does look like it's kind of topped right there. The histogram is starting to show it's softening. The slow stochastics is now below its signal line. This may be the start of something where it's starting to travel south, but only time will tell. All right, now we're looking at another ratio chart from the equally weighted S&P 500 against the normal cap weighted S&P 500. Now the ratio chart is the one that is in red and black. We also have in lime green the equally weighted S&P 500 and in dark blue the normal cap weighted S&P 500. This chart goes back 20 years. This is a weekly chart. And in 20 years, the ratio chart has only fallen off of a cliff 3 times. The 2 times before this time here, we had significant 19% and 14% corrections in the S&P 500. That's the dark blue line. You can see how the S&P dropped off of a cliff in 2008 and how it also dropped off of a cliff in 2020, experiencing significant corrections. Well, we only had a soft correction since the ratio chart started to fall down here of 10%, which is nothing. That's not a correction. That's just a pullback. And since then, we've been traveling straight north. So considering that we're down here in the doldrums and we have not had a sizable correction on the S&P 500, that's an area of concern for me. So I am concerned that the pullback here is just late to the party. Only time will tell. Until you see this action happen on this action right here, then I'm not going to feel comfortable about going long. Let me explain. So over here in 2008, on the ratio chart, we started to move sideways, and then bam, you went up really strongly in the ratio chart. The reason why you did that is because the lime green, the equally weighted S&P 500, far surpassed the returns of the cap weighted S&P 500, and that's when you got that straight line from here, went straight to there. Same thing here. You went up strongly, and that is because the equally weighted S&P 500 was outperforming the cap weighted S&P 500. And then after that time, you can see the normally weighted S&P 500 went very straight up north that way. Now over here, when you went up like that, right about here, look at that nice long bull run you had in the S&P 500. How healthy it would be if the S&P 500 were to experience a nice fat correction, the ratio chart goes bam like that, and then all of a sudden you're going to be in a long-term bull market for the S&P 500, giving us the information that we need, feeling confident that we can go long and put leverage on the table and stuff like that and make some serious cake that was made from here to here and from here to here and here, well, not in here to here, not really, because we're still in that downward phase right there. So this is like a long-term outlook looking at it from that perspective. Now we are looking at the VIX, which is the Volatility Fear Index. 3 ranges. Above this range is the upper range, which is bearish. Between the 2 ranges is the low range bullish. Below this green line right here is the ultra low range, which is also bullish. Currently, we did bottom right there. MACD has bottomed, getting ready to go north above its signal line. Slow stochastics already above its signal line and getting ready to go above 20 like that. That's giving you an indication that this is potentially going to go up. As this works inversely, as this goes up, the S&P 500, which is in dark blue, will go down. So it looks like we might be right at the beginning stages of that happening from the chart that I'm looking at. Okay, now we are looking at a 3-year weekly chart for the spiders. And here we've got our cycle brackets down below. This low represented by that low, this low representing that one. This one over here, yet to be determined. Still hasn't pulled in yet. Now, what we have here is a valid trend line drawn from this low here to that low there, and we've captured that line. And look at our trading right now. We are right at that valid trend line right there as of last week's action. So this market can technically go in either way. This low here has not been made yet. So I'm expecting a little bit of a pullback before we reach some type of a bottom, maybe around this level. And then we're going to start traveling north and we're going to surpass that old high. It's kind of like my expectation. Will that actually come to fruition? Who knows? But that's kind of where I'm at. Now let's switch over and let's look at a daily, 1-year daily. Switch over to daily over here. And let's see what things have to say for us here. All right, let's bring this up and let's open this up a little bit so you can see it fairly well. Now on this chart here, I drew in here a Fibonacci extension, okay, from this low to this high to this low. And then this numbers here are the Fibonacci's. And I put in a target zone, which is the target zone is in red. We clearly have established and hit this target zone right here. We went above the 61.8 according to this Fibonacci extension, and we've hit that target zone. So I'm expecting a little bit of a pullback here to come in before we start taking off again. This low here has yet to be determined. That has not shown itself yet. All right, now we are looking at a chart that I created on Excel to give me an idea of different asset classes and also the 11 sectors for the S&P 500, and to get an idea of how strong everything is looking. This is the information used in order to populate the chart down here. And I populate the chart, and then I come up with a percentage number for the grand total. And here is how I determine whether we get a red, a yellow, or a green. Currently, everything is green. We are looking totally solid. Now, one thing you want to do is you want to compare against last week's reading to the current week. And both of these numbers are 91 here and 82 here, indicating that we are maintaining strength across the sectors and across various asset classes. All right, guys, we are going to wrap up this video. As of September 28th, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now. September did not give us the pullback that we were looking for. Even though the market is looking bullish at this time, I don't feel like my risk to reward ratio is worth putting money at risk. I am going to sit out October in cash for now. Now, currently, as you know, I have 2 in the money covered calls that are going to expire on the end of trading on Monday. I'm just going to let those expire. I'm going to take that and leave that. Those 200 shares are going to be taken away from me. So I'm going to basically have about $122,000 in cash after Friday evening. Excuse me, Monday's trading, after Monday's trading, so Monday evening. So come Tuesday, I'll have cash that I could theoretically deploy into the market. But because I'm expecting a little bit of a pullback over the next week to 2, I'm not going to deploy that cash. I'm going to sit and watch the market action next week. If we have a substantial pullback, I may take on going long SPY, as I do feel that 2024 will end strongly, and sometime in 2025 is when we will see a substantial pullback of 20 to 40%. I showed you that in the video and why I feel that way. Now, I make these statements and I have these feelings and opinions about the market, but basically the market is an 800-pound gorilla, and this 800-pound gorilla is going to do whatever it wants to do whenever it wants to do it. So the idea is to let the gorilla do its thing and just be on the right side of the market when you're ready. It's just with the valuations and the way things stand right now, even though things look very bullish, I don't want to put everything in the table right now. I think it's more prudent to possibly take some chips off the table than put the chips on the table. That is going to conclude this video. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down, subscribe to my channel, and ring that bell to be notified when I post a new video. I thank you and wish you good trading.